Welcome to the JD Power Insurance Intelligence Podcast. I'm Carolyn Kibat, and joining me is a team of our insurance experts, Steve Crewdson, Mark Garrett, and Breanne Armstrong. Welcome, team. Thanks for joining me today.
Yep, hello.
So typically we would kick things off here with a few news items, but our topic today really has been dominating industry headlines for quite some time. So let's just jump right in and talk price. So insurance rates are still increasing, and this isn't limited to auto insurance rates. So Mark, I'm going to start with you. What is driving these increases?
Yeah, it's interesting. You talk about, this continuing coverage we're seeing on this scenario. And yeah, it's definitely not slowing down. I think there's been quite a few developments, I think, since we last talked. We saw the CPI come out and show auto, as you mentioned, up another couple of percentage points. I think it's over 22% year over year. I think what's interesting there is that CPI doesn't track home insurance rates, and home insurance rates are also, you can see varying estimates there, also up about 20%. I was recently seeing that, the average policy today is 50% higher than it was back in 2019, right? So just, 4 or 5 years ago, it's up 50%. So both of those drivers, I think there's some similarities between the costs there. I mean, it's ultimately claims costs are up. I think the SNL just released their homeowners kind of synopsis, and the homeowners combined ratio was 110. A lot of that is driven by the loss ratios because insurers are actually doing really good managing expenses. The expense ratio is the lowest it's been in the last 20 years. So it's strictly the claims costs are rising, at a dramatic rate. That's pushing up the prices, right? And carriers are taking rate across those product lines. Both, I think, auto and home were around 110 combined ratios. So we've got rising costs to come back to kind of what's driving that, right? Rising, not only is there more severe weather on the homeowner side, we had record levels of these billion-dollar events, record losses due to storms. On the auto side, it's a lot of, labor costs are going up, right? We've seen shortages of mechanics, kind of staff at shops, driving up labor costs, repair costs, just inflationary pressures are continuing to drive a lot of that.
Yeah, those are great points, Mark, around all the drivers of CPI and what's driving up claims costs. There's, interestingly, another part of what's driving up claims costs that isn't directly picking up when we look at the costs to repair or replace a vehicle, labor costs, parts costs. It's what those in the industry are terming social inflation. So I know I've heard a lot of different definitions of social inflation. One that seems to work pretty well is the non-economic drivers of cost. And largely in the auto insurance space, what we're seeing driving social inflation is more claims are being litigated. And when they are litigated, obviously they'll either end up reaching a judgment or reaching a settlement. And the size of those settlements is growing substantially. So that is also a contributor to what we're seeing in terms of claims costs going up. And I mentioned underneath that the phenomenon of third-party litigation funding. So a lot of that increase in social inflation is being driven by the fact that there's this phenomenon of third-party litigation funding where some companies and investors are investing in the plaintiff's side of a case to encourage more litigation, to encourage them to hold out longer and seeing a suit through to try to reach a judgment. And some estimates, there was recently an estimate from Bloomberg that space has seen around a $40 billion spend in the last year. And Swiss Re reported recently that those companies that are investing, or the investors investing in third-party litigation funding, are seeing a 25% return. So not likely that's going to go away anytime soon. There has been some effort on the parts of individual states to combat that. There's been some regulatory changes that have been discussed. Some maybe statutory changes are going to be discussed in the future. But as we see it right now, third-party litigation funding is fueling that social inflation, and social inflation is fueling the rate increases we're seeing across the industry.
Yeah, good point, Stephen. I think that's also why there's such a laser focus on trying to close claims quickly, too, right? Get people through that process quick, get them paid quick, to kind of maybe cut down on those, that litigation aspect. Another thing that I did want to mention, Carolyn, too, and just in terms of, what else has kind of been released since we last talked, the government agency NOAA just released their climate forecast, and there was an expectation that we are going to have an above average hurricane storm season again this year. So you think of that continuing trend of just there's been some record, I think, set every year for the last 3-4 years. Like last year was like the single number of billion-dollar events hit 28, like the highest on record. So they're expecting another above average storm season. So part of this pressure is not going away, right? And as much as they want to kind of settle these claims quickly, you get into these situations with a lot of homes impacted, and you get shortages of crews to do the work, material shortages, and all these things that kind of drag these claims processes out. So we've seen the average claim, customer getting their final payout eclipse over 30 days in our last year's study. It was about 32, 33 days was the average claim experience, essentially, in getting that final payment from a customer. And that's just, when we reported our last property study, SAT reached a 7-year low. The industry was down 5 points. And a lot of that was due to these long-tailed, dragged-out claim experiences.
So, Mark, how are we seeing this new environment influencing customer satisfaction in the claims space?
Yeah, well, I can speak to that probably best with the last study we released, our property claim study, where a couple of trends that we saw happening are, one, consumer deductibles are going up. And I think part of that may be a byproduct of a way to minimize some of these rate increases, right? That maybe they're raising their deductibles. We also do understand, like, as there's more storm damage, though, wind, hail deductibles are kicking in, and those are higher as well. So ultimately, we have this dynamic of rates are going up, customers have a claim, and they see their deductible going up. I think that's also having a negative impact. And we're seeing out-of-pocket costs tick up slightly. There was a 3 percentage point increase and customers incurring some kind of out-of-pocket spend. So you add that with higher deductibles, and that was a big driver again, not only just these long-tailed claims, but the fact that they're spending more money in the claim process is also having a big negative impact.
So obviously there's some elements here outside of carrier control, but Breanne, what can insurers do to mitigate the impact on customer satisfaction of these continued increased prices?
Yeah, thanks, Carolyn. There are quite a few things carriers can do. Ultimately, it's going to be hard to totally mitigate the impact, but, communication is really key. So proactive notifications around the premium increases. I know it's something we keep kind of reiterating again and again, but I think that getting ahead of it, getting notification that comes from if the insured has an agent, coming from the agent, right? And it opens up that line of communication so they can discuss potential options for, maybe reducing the premium or trying to like counteract that as a customer, right? And so, also having the insurer reach out, having the information very easy to understand on the website, right? So being able to access it online through the app, facilitating things that help the customers understand their policy. So not only understand the reason for the increase, but also the policy overall. And so, that's something we talked about last time, but it really cannot be stressed enough that the more a customer understands their policy and what's covered, the more satisfied they are, the more accepting they are of changes to their, the price that they pay because they understand why. And it's really, about facilitating that in the relationship and kind of that transparency and trust, which is very important in the relationship. The other thing too, is that, if you're an agent, you can help your customers by proactively shopping for them, right? So looking out for them before maybe the premium increases hit, and looking for other options in order to, help them bring their premium down. So those are just a few ways, I think. I know Steve might be able to talk too a little bit to, some options as well.
Yeah, Breanne, those are great ideas coming directly from the voice of the customer, and a lot of the research we do that a customer can end up just as satisfied when they had a premium increase as a customer who did not experience a premium increase if the insurer communicated the increase in the right way. And I think we have a list of 4 or 5 best practices that if insurers engage in those, they end up with a customer that's just as satisfied. So in other words, just as likely to be retained after getting a premium increase as their counterparts who did not get a premium increase. But aside from once we've taken rate as an insurance company and now we're communicating that, in that rate-taking process, what we also have seen emerging over the last few years is the level of detail around automotive data is one example of better data that insurers can use to better price their products and better price their policies. So there's many of those out there, but one that we've been talking to a lot of insurers about is better data around the what's included in terms of features, safety features, etc. on a vehicle, and kind of abandoning some of those depreciation curves that worked for generations but haven't worked in the last few years for more real-time valuation data of the vehicles that are in their book of business. So those are other ways. Just using data to better price policies is something that can be done to help the health of the insurer financially and help make sure that the customer is being priced accurately. So beyond social inflation and how third-party litigation funding is affecting that, we're also seeing that more and more states are revisiting some of the regulations they've had over the years around use of different forms of data. So we're seeing some states perhaps allowing the use of CAP modeling in the future and other forms of data that insurers can use to more accurately price policies. So if you think about overall the use of more accurate pricing data when it comes to the physical damage around the vehicle, outside of auto claims, if you look at property claims and the use of CAP modeling, etc., we're seeing the tide shift here in the space where more accurate data will be used in future years to present a more accurate price to the customer. And the winners there will be both the insurer and the customer. The insurer will have more adequate rates, they'll be more precisely pricing their policies, and the customer will win by having a more accurate price for the policies they have.
All right, Steve, Breanne, Mark, thank you so much for joining me today. Obviously, price is a big topic, so if any of our listeners are interested in discussing this further, please do not hesitate to reach out to the experts here. Thank you also to Dan, our producer, and thank you to our listeners. We'll see you next time.